Okay, good afternoon. So today, as usual, if you have any issues, let me know in the chat box. Can you hear me now? Cannot. Yes, very good. Thanks for responding. So today we'll be talking on chapter 20, okay, on firm securities. All right, it's a very easy chapter, a very short one also, a very short tutorial today. So most likely we will complete it very early. All right, and then I will spend the rest of the time. If you have any issues or any questions that you ask me, you can address it to me later on. Okay, so as usual, as the normal conduct of the class, if you have any concern or issues or I'm speaking too fast, you need me to slow down, let me know in the chat box. Don't be shy. Okay, let's start with today's tutorial. Look at today's tutorial. Again, incorporation, question number 1. Again, incorporation is proposing a rights offering. Okay, a rights offering here is sort of like issuing shares. Okay, issuing shares. So presently, there are 550,000 shares. Okay, there are currently 550,000 shares outstanding, selling at $87 each. All right, there will be 85,000 new shares. This is new shares, that are issued at $81. Okay, so come to the question now. What is the new market value of the company? So the formula for new market value, as usual, when I put it in blue, means it's a formula. New market value is existing shares market value plus new shares market value. Okay, existing shares market value plus new shares market value. So what is the existing shares market value? Currently 550,000 at $87. The new shares issued 85,000 shares, each one priced at $81. So this total up will give you the new market value of this company. So this company now is worth $54,735,000. New market value of the company. This is the again incorporation value, $54.735 million. Okay. Part B. The question asks us how many rights are associated with one of these new shares. All right. How many rights are associated? So to count number of rights, all right, okay, number of shares associated with the new shares. All right, so how many old shares equivalent to one new shares? So old shares divided by new shares. 550,000 over 85,000. So there's around 6.47 rights per new share. Okay, 6.47 rights per new share. So each share is represented by 6.47 old share. Okay, so this is another formula. Old shares over new shares is equals to number of rights. Okay, so a bit confusing here. So students don't know what is rights. So rights is actually shares lah. Okay, rights is actually equals to shares lah. It's the same thing. Okay, so C, just that there are different way to call it. C, what is the X right price? Okay, what is the X rights price? All right, so X right price in blue color. Value of a right at X right price. Okay, what is X right price? All right, X right price means what is the new value of the share price after including this new set of shares. So the formula here is new market value divided by total shares. So the new market value now is 54,735,000. Now your number of shares from 550,000 plus another 85,000. So this is a new set of shares. So now you're going to find the new value, the overall of all these shares now. Because you have 550,000 shares sell at 87, another 85,000 new shares sell at 81. Different price, right? So at average now, each share costs how much? You're finding the value of a share, value of each shares after issuing of new shares. So here you manage to get each shares will cost or at the market value of $86.20. Okay, so each shares now is $86.20. 550,000 at 87, 85,000 at 81. So at average, each shares is around $86.20. All right, that's it. This is the value of a rights or value of X rights price. X right price means after including the new shares, how much is the value of each shares. Okay. Moving on. So if you've got issues, please stop me. If not, miss, let me finish here. I'm finished D. If you have any problems, you voice it out to me. So D, they want you to find the value of a right. Value of a right. What is the value of the rights? Okay, basically these are price. Okay, price after rights issued. Okay, means the new price. The new price, the new average price minus of the price of rights. Okay, so the new price, the new average price of stocks, this is the average price of stocks, average price, and this is the new price, new stock price. So the average is $86.20. The new stock issued at $81. So the value of the right is the difference between these two. So each new shares being issued are actually having a value of $5.20. In other words, profit lah. Okay, so each new shares which is priced at $81, all right, now after introduced in the market, they bring down the price to $86.20. Okay, so these new shares, each one has a value of $5.20. That's what it means. Okay, that's what it means. All right, so after going through ABCD, any confusion or any questions, please address it to me now. Come. Any problem so far? No? Okay, I don't see any response on the chat box. All right, so I don't know, maybe due to internet connection or whatsoever. So don't wait until I ask you, is there any questions? Only you ask me. You can start asking even before I completed the whole questions. So after I complete it, I can straight away address to your questions if you are lost. All right, so far so good from Bailey. So that's very good. Okay, that's very good. All right, if so far so good, I assume the rest is also in this situation, you are all good. Then I'll move on. But if you are not okay, please let me know. All right, let's look at E now. Why might a company have a rights offering rather than a general cash offer? Why they want to issue new stocks or new shares and not a general cash offer? Okay, so very simple. To answer E is very simple. Why they choose to issue new shares and not just take in general cash? So a rights offering usually costs less. Okay, so one thing, number one, cost less. Number two, it protects the interests of existing shareholder. Protect existing shareholder lah. And lastly, it protect underprice. So 3 reasons why they issue rights instead of general cash. Number 1, it costs cheaper. Number 2, protect the existing shareholder. And lastly, protect being underpriced. Okay, so they don't screw up the market. So this is the theory one. This is the 3 reasons why shares and not cash. So these are the 3 reasons. Again, the 3 reasons why shares, not cash. Okay. All right. No issues, huh? Still no issues. I'll move on. So question number 2, very interesting. You look at question number 2, they tell you Taipei Co and Tainan Co. So there's 2 companies here. Taipei Co and Tainan Co. 2 company, both got an IPO of $40. Okay, both issued IPO of $40. But there are criteria here. One of them, okay, is undervalued by $9. All right. So one of them is undervalued by $9. So one of the stock supposed to be priced at $49. Undervalued, ma? Again, undervalued by $9. So they issued 40, so it's undervalued by $9. It's supposed to be 49. Another one is overvalued by $4. Overvalued. So overvalued means it's supposed to be only 36, but overvalued and make it into 40. This one 49 make it into 40. So one is overvalued, one is undervalued. This is the story here. But you have no worry of knowing which is which. You don't know which one is undervalued, which one is overvalued. So in this case, you plan to buy 1,000 Taipei and 1,000 Tainan stocks, both at $40. Okay? If an issue is underpriced, means this is 49 supposedly, but it's priced at $40. If an issue is underpriced, okay, it will be rationed and only half your order will be fulfilled. So this $49 one, you buy 1,000, you only get 500 because it's already underpriced. Okay, so now the question come in. The first question here, if you could get 1,000 shares in Taipei and 1,000 shares in Tainan, what would your profit be? Okay, if you manage to get 1,000 each, your profit, irregardless which one is overpriced, which one is underpriced, you know you can buy 1,000 overpriced stock, and that means 1,000 stock you will give you an earning of $9. Okay, you bought an underpriced value. So once it's released in the IPO, the price will shoot back to 49 because the actual value is 49. Another one is overpriced by $4. So another 1,000 will be overpriced by $4. So you will lose $4 once it's being open to public. So in the end, you get a profit of 9,000 minus 4,000. You get 5K. This is to answer question number 1. Okay. Question number 2. What profit do you actually expect? So reality profit, they tell you, right, the overvalued one and the undervalued one, you can only get half. So half means 500 times 9. Okay, profit of $9 per shares. Okay, you can only buy half of it, 500. And the overvalued one, you can get full 1,000. So you make the loss of 4K here. So do you still make money here? Yes, 4.5 minus 4,000. You still make a profit of 500, even after the rationing. Okay, can see. Any questions so far? No, huh? All right. So actually, this situation here of undervalued and overvalued, okay, it's a scenario. This scenario, it's called the winner's curse. Okay, the winner's curse. All right, you see, there's one undervalued stock, price $40, but it's actually reality is only $36. So people will be thinking, oh, I want to buy this stock, I want to buy this stock. But you don't know the actual value is actually $36. End up, you bought it at $40, which is overpriced. Yes, you obtain the stocks, but at an overpriced status. So this kind of situation is called a winner's curse. You win the bidding, but it does not benefit you because you bought it at a value higher than its supposedly value, which you don't know. So for example, you go to an auction. All right, you go to an auction, you want to buy an antique vase or something like that. Okay, so the antique vase, the market value you don't know yet, but you go to the bidding there, everyone is bidding like 1 million, 2 million, 3 million, 4 million. So you want to win it, you want to win the bidding so badly, you make an offer $10 million. You got that antique vase, you bring it home. After you got it, you realize after valuation, after professional looking into it, that vase is actually worth only $8 million. So you overbought it at $2 million. Yes, you win the bidding, but the problem is you bought it at the overprice. Or in common terms we use in the modern world now, it's called overrated. Overrated. Okay, so people line up for Yeezys. Yeezys initial price being released is $400-$500 per pair. But after people buying, they come up from the store, they know, oh, this is a limited edition, everyone lining up there. So I jack up the price, I sell you $1,500. You bought it home, you bring home. Then you realize, or after counting the world amount of Yeezys, the valuation, okay, the Yeezy is actually worth around $1,000, $2,000 only. But you bought it at $1,500. So you overbought it, you overrated it. Okay, the value is not that high, but you are purchasing it at a value over of the initial value. So that's the winner's curse. This is a term to address to paying extra for a thing which is not worth that much. Okay, so this is just an example here to tell you what's the winner's curse. All right, it's not in the questions. The question's not mentioning anything about it, but just letting you know this is winner's curse. Okay, moving on to question 3. I think counting the profit just now is not a problem. The winner's curse then might confuse you further. So if you have issues with winner's curse, you can always Google it further to find out what is it about. Check it on textbook. There are a lot of definition about it. Okay. Coming to question number 3 here. Well-bred service company earned 50 million in 2005. So 2005 income $50 million and paid 20 million in dividend to the holders. So dividend 20 million. Okay, and then shares outstanding. Available shares in the market 40 million. So if the current market price of well-bred stocks is $31.25, so the spot price is $31.25, calculate the following. Okay, calculate the following. A asks us to count the dividend payout ratios. Dividend payout ratios. So what's the formula for dividend payout ratios? There are two formulas. Number one, you can either use DPS, dividend per share, divided EPS, earning per share. Okay, DPS or divided by EPS. Or the other formula, formula number 2, is total dividend divided by net income. So this question, which one is easier? All right, you already got dividend, you already got your net income. No need to count DPS and EPS. Straight away use dividend divided by net income. Faster. Okay, dividend is 20 million divided by net income of 50 million. Your dividend payout ratios is 0.4 or 40%. Okay, But if you want to find DPS and EPS first, you can find one by one. Then only you calculate also can. But I'll find the easiest one. So this one is already available. Then use this. Okay, use this. Very easy. So blue color is the formula. So I already changed the color here. So B, nominal dividend per shares. Listen. So the next one, they want you to find the DPS. Dividend per shares, assuming well-bred pays dividends annually. So you want to find DPS per annually. Dividend per shares annually. So this formula is actually total dividend divided by total outstanding shares. So total dividend value is 20 million, right? Outstanding shares is 40 million. So dividend per shares annually, all right? 1 year getting dividend of 50 cents. 50 cents annually. Okay, this is B, 50 cents annually. All right. Moving on to C. C, same question as B, but now they ask you quarterly. Nominal dividend per shares, assuming well-bred pays dividend in equal quarterly payment. So now you're talking about DPS quarterly. So annual DPS is 50 cents. Now you 1 year separate it into 4 times. So each quarter payment is divided by 4. Yearly divided by 4, 50 cents divided by 4. Each quarter, you're getting 0.125 quarterly. Okay, very easy. All right, one annually, one quarterly. Lastly, the last question, the donkey on D, current dividend yield on well-bred stock. All right, current dividend yield. I don't know how many of you still remember the formula, but current dividend yield, let me write off the formula for you. Current dividend yield formula, it's equals to annual DPS divided by current share price. Current share price. So annual DPS is 50 cents. Current share price is $31.25. Okay, so just 50 cents dividend divided by 31.25. Your dividend yield is 0.016 or 1.6%. Easy. Okay, easy, right? So up to now, any questions from you guys? Come. Can follow, cannot follow? All good. No questions. Actually, very simple. Actually, today's tutorial very, very easy. Piece of cake, very easy. All right. So, no questions. We move on. Question 4. So those who are confused and lost, you think that you don't know how, or those who came in late, all right. All these are already being streamed on YouTube now. So you can, by now, you should already know. If you follow me on YouTube, you will see the updates, and then you can watch the tutorial questions and tutorial discussions being done there. Okay. After watching, still have no issues, come and discuss with me after the class, or you can even email me. Okay. So we are done with just now question 3. So now question 4. Question 4 here, before issuance of new shares. Okay, before new shares are being issued, there are currently 100 units shares outstanding. Okay, and each of these shares is $10 per shares in Dave Dailies Limited. So the firm sell 20 shares under the right issues for cash at $5 per share. So they issue new shares, 20 new shares at only $5. Okay, so the question asks you now, A, what is the price of each shares after the right issues? So this is the same like just now. Value of a right at X rights price. So they want you to show what is the average value of the shares now after the new issuance. Okay, so the new market value, 100 shares at $10 plus 20 shares at $5 divided by the total number of shares, 100 plus 20. So you get 1001 divided by 120. Each shares is $9.17. Okay, 100 units $10, another 20 units at $5. So at average, each shares is $9.17. All right, the new share value is $9.17. Okay, that's for A ini, simple. So B, calculate the value of the rights. First question. Number one, they want you to count the value of rights. So I show you just now, value of right is basically equals to, okay, your X right price minus the new rights price. Okay, so X right price, that means this now, A. All right, the new average price is $9.17. The new price is $5. The 20 issued at $5. So this gives you a value of the new stock have a value of $4.17 each. Okay, that means after going to the market at $5, now the average price become $9.17. From $10 become $9.17. So those new fellow who join at $5 will has a chance to pull it to $9.17 straight away. They make a value of $4.17. That's the value of the rights. All right. This is the first section, first question. Calculate the value of the rights. Next, how much the new shareholders gain? New shareholder gain. So this is the 20 stock owner. The 20 stock owner gain 9.17 is the market price minus their purchase price at $5. So they're making 4.17 each stocks. So they got 20 of it. They are making $83.40. So what is the loss of the existing shareholder? So existing shareholder, 100 units multiplied by initially $10. Now it's only $9.17. So they make a loss of $83. So new one gain 83, old one lost 83 in value. That's it. Okay, one gain 83.40 cents, another one lose $83. So fair lah. It's equilibrium, it's balance off. So any question for question number 4? Are you guys okay? Not okay? Let me know. Come. Oh, very good, huh? This class. All perfect. All at a perfect situation. No issues at all. So very good. I'm happy to hear so. Okay, that means you guys are very well prepared. Okay, number 5 here. Number 5 here, super thrift pharmaceutical companies traditionally pay an annual dividend equal to 50% of its earning. Okay, this super thrift pay annual dividend 50% of its earning. Okay, The earning this year are 30 million. So 50% of 30 million. So dividend will be 15 million. Okay. The company has 15 million share outstanding. So earning is 30 million. Dividend 15 million. Shares outstanding 15 million. Investor expects earning to grow at a 5% annual rate in perpetuity. So this is the constant growth rate, perpetuity 0.05. And they require a return of 12%. So interest rate is 12%. Required rate of return is 12%. So 0.12. So A. What is Super Thrift current dividend per share? So number one, find your DPS. Okay. So DPS, total dividend payable, divided by total shares. Okay, so dividend payable is 15 million, right? Dividend 15 million. Number of shares 15 million also. So each dividend per share is $1. Each dividend per share is $1. Second part of the question. What is the expected to be next year? So this is dividend per share $1. This is your D0. The payment for this year, D0. Dividend this year is D0. Now, second part, they want you to find D1. So D1 is equals to D0 times 1 plus G. They tell you it's a constant growth rate, right? Okay. So $1 times 1 plus 0.05. Power of 1 year only. So this will give you $1.05. So the dividend next year, 1.05, $1.05. Piece of cake. Part B, they ask you, use the Gordon Growth model to calculate Super Thrift stock price today. Gordon Growth model, it's your dividend growth model, the DGM. So what is DGM? DGM formula is price at time 0 equals to D1 divided by R minus G. Or also can be written as D0 1 plus G power of T divided by R minus G. So to find the present value here, very easy. You already got your D1. Okay, you already got your D1. Don't have D1 also can count. Got D1 easy. 1.05. 1.05 divided by required rate of return is 12%. Constant growth rate is 5%. So your present value you calculated is $15. $15. Okay. So question 5. Any problem so far? Can follow, cannot follow? I still didn't see any response. So means all of you are still good. Okay. Very good. Fantastic. All right. Now, done. No more calculation. Last question here. Question number 6. Why are the cost of debt issues less than those of equity issues? Okay. Why debt is cheaper than equity? Okay. Why debt and not equity? So there are a few reasons to it. Number one, cost of debt. Okay. Cost of debt is lower. Why? In the sense of complying the government regulation. What does this mean? Okay, you know, equity means issue stocks, shares. Debt, oops, debt means bonds. Okay, so to issue bonds is easier than to issue shares now, of course, because if a company cannot issue shares, okay, they need to go through IPO. That means they need to be listed, and then this will go through a lot of requirement, a lot of processes. So it will be very taxing and very pricey to comply with the government regulations. This is number one. Okay, this is number one. Number two, risk of debt is lower. As you all know, when you issue bond, okay, you give a coupon rate. All right, this is the return to your lenders. You borrow money from them, you give them a promise rate, and it's fixed over a certain number of time until maturity. Shares, whereas it's very volatile. All right, why? Share price will be fluctuating depending on the supply and demand. So when there's fluctuation and volatile, risk of equity is higher. When something is volatile, of course, the risk is higher, right? Common sense, logic here. Okay, when the risk of the equity is higher, right, there is a potential of mispricing. Okay, that's why risk of debt is lower. There's no bond, bond, no mispricing. It's fixed. Okay, bond does not fluctuate. It's fixed. So these are the two reasons why debt and not equity. Number one, cost of debt is lower. Why? Because to comply with the government regulation is easier. To issue a debt is to issue a bond is easier than issuing a shares. Number two, the risk of debt is lower because it does not fluctuate. Okay, so this is the wrap for today's tutorial. So is there any questions from you guys before I share the attendance code with you?